Welcome everyone to our workshop today on taxation and insurance. This is our third workshop in the Cost of Doing Business series. Before we commence, I would like to acknowledge the Tasmanian Aboriginal people as the traditional owners of this land and pay my respects to elders past and present. My name is Bronwyn Kidd. I'm the Program Manager at Business Tasmania, and I'm joined today by James from Interlink, Deb from Avisio, and Mikala from the TCCI. Before we get into the main presentation, I'm going to do a short overview of Business Tasmania and the wonderful support that we have on offer to all Tasmanian businesses. So we exist to help Tasmanian business owners start, run and grow their business. We exist of a service that's available for free for you. You can call us through our helpline anytime, and we act as sort of a concierge service to help direct your inquiry to the right place. So you can call us with any question and we'll do our best to connect you with the right service provider, which is usually a government supported service provider, and that's always a confidential and free service. We're available statewide and we help business owners no matter what stage of business they're in. The services that we have available are varied. We have our helpline, but we also have a range of events and workshops, just like this one that you're at today, that we host, and we collaborate with a lot of other fantastic providers on. We have our event calendar on our website that you can access and see events that are in your area or via your industry, or also online events too. We have a fantastic new website, just businesstas.gov.au, which houses a wonderful scope of resources for you, and also some tools, things like grant programs, and lots of information about starting and running your business and right through to even closing your business. We also have a separate advice service in addition to our phone line service, which I'll go into now. So that's called the Tasmanian Business Advice Service, and we have a second branch of that called the New Business Support Service. So these services are delivered by independent business advisors from across Tasmania. And if you've been in business for 12 months or less, or perhaps you haven't registered your ABN yet and you're looking to get some support in starting your business, you can access up to 2 hours of free support each financial year through the New Business Support Service. And if you've had an ABN for 12 months or more, you can access up to 5 hours with a business advisor through the Tasmanian Business Advice Service. And these advisors are available right across the state. So you can meet face-to-face or online, or meet with them via phone. So to access the service, you can visit the website businessadvice.tas.gov.au, or you can call us at Business Tasmania and we'll connect you with an advisor that we think is suitable, or the advisor that's in your area. So each of the advisors are generalist advisors, but they all have different backgrounds and different expertise in their own fields. So if you're unsure who may be best to see, you can have a look at the bios for the advisors on our website, and you can pick someone that might be able to help you with the particular area you have a need in, whether that be finances, budgeting, marketing, or anything workplace related or so forth. I'll just also add to that one that the hours that you get each year will reset on the 1st of July. So there's a little bit of time left to finish using any hours that you haven't already used. And then you get another 2 or 5 hours from the 1st of July, which is really fantastic. All right, here's a link to our event calendar if you're interested in the upcoming events that we have. And here are the events that are remaining in this series, the Cost of Doing Business series. So next week we have leasing a premises, then we're talking about workers' compensation, and lastly we're looking at pricing your products. So lots of great topics to come. So I highly encourage you to register for those if you haven't already, or keep an eye out for the recordings on our YouTube and social media. If you'd like to connect with us, we have our phone line at 1-800-440-026. We also have an email address, which we're very responsive at responding to. So that's ask@business.tas.gov.au. And then the best place to stay up to date with anything business related in Tasmania is our newsletter. So we send out a newsletter weekly. If you're not already on there, I highly encourage you to sign up and get the latest news and updates, even grant programs when they're available. They're all announced on our newsletter. All right, and that's it from me. So I'll hand over to Mikala to jump into the presentation.
Fantastic. Thanks so much, Bron. Can you see my screen okay?
Yes,
Does that come up? Wonderful. Welcome, everyone. Thanks so much for joining us for today's Cost of Doing Business event. So today we will be talking about taxation and insurance, and we're splitting it into two parts. So the first part will be taxation, and I'm going to be speaking with James. He's our resident expert on that one. And then for the second half of the session, I'll be speaking with Debbie about insurance. So as Bronwyn said, if at any point you have any questions, please pop them in the chat. If it makes sense, Bronwyn will jump in and ask the questions of Debbie while we're going. Otherwise, we'll save them till the end. And we also just need to keep an eye on time to make sure that we do cover all of this within the hour. So at the end, you might want to stay on for some questions if there's still more to be answered. Okay, so let's start with James. And the first question I've got for you is, what tax obligations do small businesses need to know about?
Thanks, Bronwyn. Thanks, Mikala. Just as a start, I'm really happy to take questions throughout, but if you feel sensitive about an issue or if you want to keep something confidential, more than happy to follow up outside of the session. I'm actually one of the advisors that State Growth engaged to actually assist with you in either the 2 or the 5 hour capacity. So really happy to catch up after if you don't feel comfortable with questions in this session. In terms of tax obligations, there is numerous obligations that all businesses must adhere to. You will have heard of most of them. They do absolutely have different implications and obligations, which ranges everything from ABN registration. If someone gives you an invoice and it does not have their ABN on it, you need to withhold tax and you need to forward that to the tax department unless they have a no withholding required declaration. So even though you need an ABN registration, if someone doesn't quote it to you, that puts obligations on you as a business to withhold that tax and take reporting responsibilities. GST, I'm sure everyone's familiar with GST. One of the traps that comes into play here is that there's a threshold of $75,000 for profit companies and $150,000 turnover a year for not-for-profits. Where there can be confusion is that 75,000 and 150,000 is not on a 1 July to 30 June basis. That's on a rolling 12-month basis. So it's where you exceed those thresholds in any 12-month period triggers the liability. So you do need to watch out for it to make sure that you register within 28 days of hitting it, or you potentially become liable for the GST, even though you haven't charged for it and even though you haven't collected it. Obviously, you got your BAS statements to report your GST, your PAYG, your instalment payments. You've got your income tax lodgement responsibilities. We've got record keeping obligations, and we'll go through that in a little bit more detail. You've got your PAYG for your employing staff. Superannuation. Now, superannuation changes from 1 July 2026, so only in a few weeks' time. We're under the new requirements. It's called payday reporting, and you must pay the superannuation when you make the pays. You can't wait till a month or previously 3 months later. It actually has to go through at the same time as the pay run. And that needs to be through single touch payroll. So single touch payroll is the online system that hooks it automatically into the tax office. And that can't be manual anymore. You've got FBT responsibilities. That only applies where you have employees. So if you're a sole trader and you provide benefits to yourself, that does not give rise to FBT. It only applies where you've got employees and you're providing them with a benefit. Payroll tax. Payroll tax is a state-based tax. If you're a single organisation, that cuts in Tasmania at $1.25 million of payroll. And then there's a concessional up to $2 million, and then it goes to a higher rate from 4% to 6%. There's also various contractor reporting obligations. So depending on what industry you're on, if you're in the construction industry, cleaning industry, courier, IT, you have to report payments to contractors to the tax office. It's not a withholding obligation, it is just a reporting obligation. And then there's the fuel tax credits, which apply to certain industries as well, which can be agricultural, transport, where a business can get a tax credit back where they're using vehicles that are more than 4.5 tonne, and that's done through the BAS process on a quarterly basis. So as you can see, there's a whole lot of different obligations that not all businesses will need to comply with, but you need to be sort of aware of in terms of what's out there in the landscape. You're on mute, Mikala.
Thanks, James. And so moving on from that then, what records do businesses need to track from day one?
So the tax office or the legal rules are quite broad, and it doesn't actually say you must capture all invoices or you must capture all bank statements. It doesn't specify at that level. However, it's expected that business would keep all those normal business records, such as invoices, such as bank statements. What the tax office requires is that you keep records that explain all transactions. They must be in writing, albeit that they can be electronic or paper, but they can't be in a form that could be changed or manipulated. They must be able to be converted into English. You must keep them for a minimum of 5 years. And that 5-year really cuts off. It's not 5 years from the date of the transaction. It's actually 5 years from, say, the lodgement of your tax return. So if you lodged a tax return late, it's actually 5 years from that date. But then other records last much longer, in that if you've got losses or trust accounts, you actually got to keep them longer than 5 years. So 5 years is generally the minimum, but you do actually have to keep records for longer than that. And the outcome's pretty straightforward. It's if you don't keep the right records, you risk losing the deduction. You can get penalties. You can get interest payments. And the tax office, if you can't prove it, can come in and actually make an estimate, and they can actually estimate what your income would have been, and they can then apply tax at that, and you can get penalties and interest on it. So it's really important to keep the right records, albeit they don't stipulate exactly what record must be kept for all transactions.
Thanks, James. So I'm just going to ask a quick question here. So that 5 years, it used to be 7 years, is that right? And now it's been brought back to 5, or is 7 still considered the safe period?
So this is where it gets a bit confusing. The 7 years is applied by ASIC in the company's code, and so that's a legal requirement to keep records for 7 years there. Tax is a little bit different with different rules. So the 5 years is for tax lodgement records, but then there are some things that can change that and actually make it longer.
Awesome. Thank you for clarifying that. Okay, so what are some of the common pitfalls that our businesses need to be aware of?
Yeah, good question, because this is something which comes up frequently. And the poor record keeping is something which a lot of businesses suffer from. They don't keep the right records. They don't keep the records for GST. They don't keep their records long enough. And the simple, you might get away with it, but if the tax office does audit it, you can be hit for higher taxes, loss deductions, penalties, and it can also open you up to a larger ATO audit. If they ask for copies of records and you can't provide it, it's quite possible that they will then do an extensive audit of you and your records, looking right across the whole business. Mixing personal business expenses is another area that does cause issues. It's always recommended that you keep a separate bank account for both business and for personal, so they don't get mixed up. Cash flow issues around tax and GST, not saving enough throughout the year, not putting enough away for when the payments aren't due. Missing deductions, so when you don't have the right records, you miss things like your motor vehicle expenses or your home office or other costs. Claiming private expenses for business purposes or in your tax return. That is an area that the tax office is more and more on these days. And then just incorrectly for businesses treating an employee as a contractor, when it might be for super purposes, it might be for fair work purposes, it might be for tax purposes, that when a person issues an invoice, they automatically think that, they've invoiced, they've got an ABN, they're therefore not an employee. I can treat them as a contractor without all the obligations that sit around super and entitlements. And there's a number of tests you need to work through, but that is another common area businesses really get themselves into trouble on.
So if someone does come across any of these pitfalls or have any questions about them, what assistance is available to them?
Yeah, so there's I listed out a few of the ATO tools here. They are actually really good tools. The record keeping and evaluation tool sounds really dry, but the actual online tool is really comprehensive and really does spell it out. They've got a home office calculator, which helps you calculate what expenses, and there's several ways you can claim home office to take you through that. There's a viability cash flow tool, which helps you understand your cash flow and your debt. And then they've got another tool, My Deductions, where you can use it as a record keeping for your business or personal expenses to claim in your tax. So the easiest way to find them is you just go into Google, and if you go ATO record keeping evaluation tool, it'll come up top in the search rankings, and the same with all of those. Some of the other resources you can go to, the ATO do have small business line where you can phone up and ask for assistance. You might want to make sure that you've got more than 5 minutes put aside, because it can take longer than that to get through the phone system, unfortunately. But it is a good resource. They are very helpful. They won't give you tax advice though, but they will certainly lead you to the right resources that you actually need to be able to solve your tax issues. UTAS has a tax clinic where they provide free tax assistance to certain eligible people. So not everyone can apply for that, but they do have free assistance available there. Obviously, you can go to your registered tax agent or your bookkeeper. Or for those people who are into AI, there's some really good AI tools coming out. Yes, you can jump into ChatGPT and do a search. But there's some specific ones such as Empathic, which is an Australian tax tool. You can sign up for free. You get, I think, half a dozen questions a month, and it provides some really detailed and extensive knowledge around what's deductible, what's not deductible, how to fill in your tax return, what boxes mean what to tick and what not to tick. So the Empathic tool is certainly a good one for people who aren't using a registered tax agent or to do their stuff for them, that can really provide some very cheap and easy help.
Great, thanks, James. And I think Josh has been sharing some of those links in the chat as James was going through them as well. So the next question, we are coming up to the end of the financial year. So what issues should a business consider or look out for prior to hitting the 30th of June this year?
So there are a number of things that businesses can look to do before 30 June to actually help save their tax position for this current year. People are probably familiar with the instant asset write-off, where you can spend up to $20,000 per individual asset and claim a full 100% tax deduction. This year, there are some rules around when it's first used and payment and the like, but that's certainly something which over the next few weeks, if you have a tax issue, you might want to look to bring forward asset purchases, which can be new items, it can be second-hand items, it can be vehicles, it can be computers, a whole range of things. Prepay expenses. So you might actually have expenses which are due next year, but subject to certain rules, such as you can't be prepaying for more than 12 months and your turnover needs to be less than 10 million. You can prepay to claim tax deduction in this tax return, even though the expense relates to next year. So, and that can be things such as insurance, it can be rent, it can be subscriptions, it can be a whole host of things that you can look to do. Writing off bad debts. So the tax office actually does require you to actually write off unrecoverable and bad debts prior to 30 June in order to claim a tax deduction this year. So looking at what debts you've got, and if they're not going to be collectible, write them off in the books at 30 June, not after. Get the immediate tax deduction now. And that can also have GST implications too, in if you've had paid GST on them, potentially claiming back GST payments you've made. For those who've got trading stock, when you value trading stock, you can actually write down the trading stock at 30 June down to what's called the lower of cost, so that's what you paid for it, or net realisable value. And net realisable value is looking at what the stock's worth. So if it's gone down in value, if it's got damaged, if it's obsolete, you can actually write it down to a lower amount than what you paid for it and claim a tax deduction on that lower amount. And that needs to be done by 30 June. Superannuation is another one that you need to be conscious of. You can only claim a superannuation contribution if you actually paid it prior to 30 June, and it must have been received by the super fund prior to 30 June. So if you paid it on the 30th of June and the super fund didn't get it till next year, you miss getting the tax deduction in the current year. It's on a cash receipt by the super fund basis. So just being conscious of when you make the payments, not leaving them to the last day or so, such that the super fund might not have actually got the payment. You can also look at revenue recognition in terms of if you're on a cash or an accruals basis, and potentially delaying some of the invoicing to the following year, particularly if the service hasn't been fully provided, or recognising things as prepaid revenue. So taking it out of this year's revenue on the basis that you haven't actually delivered the service. So taking it out of your books and putting into next year to push the revenue back and the profit back to the following year. And another thing just to think about is with director fees and employee payments and bonuses, there needs to be an obligation to actually make that payment that must be locked in prior to 30 June. So if you're looking to pay employees, say, a bonus, if you had an obligation as at 30 June, even if the bonus hadn't been paid, that obligation could be part of their employment contract. Might be, in the case of like a director fees, it could be a board minute. So actually recognising that and documenting that prior to 30 June would let you make a tax deduction this year, even though the payment's not been made until next year. So there's a number of things you can look to do, which all added together can actually make quite a significant difference on your taxation obligations and payments.
Thanks, James. And if someone does want to go and get help to understand and to do all of these things, what kind of costs are they looking at and what should they expect?
Yeah, this is a really tricky one. It's a bit like how long's a piece of string, because there's so many factors that really come into play. A major one's obviously the state of your records. If you're going along with a shoebox full of receipts and your accountant's having to put them together, that's just going to add time and money and effort. And accountants do charge by the hour. So the better prepared you are, the better your records are, is going to have a very significant difference on what you're going to end up paying. There's issues then around the complexity of your structure between if you're just a sole trader, if you're a business, if you've got a company, if you've got a dual structure, all add to complexity, all add to time, and all add to cost. Obviously, the number of transactions, the more transactions, the more things to look at, the more work. Whether you do all the calculations, such as if you've got assets you're depreciating, if you're doing the depreciation schedule, or are you getting your accountant to do it, all add to the time. There's certainly industry reporting obligations, whether you're in the construction industry or agricultural industry. There's whether the specific company matters, whether the CGT events and the CGT calculations, and also importantly, what level of assistance does your accountant provide? Are they just giving you a tax return and preparing a tax return, or are you getting to planning and structuring and other advice outside of it? So the number can really vary significantly. So a simple salary and wage return might only cost you $150. A simple sole trader business might be $500, even up to say $3,000. Or if you're moving into a more complicated structure with trusts and companies, it can quite easily go up to $5,000 by way of the fees. But there's a lot of factors that come into play, and there's no, it's going to be $500 for this type of return, because there's too many variables that come into it. The more work you do, the less work the accountant does. And when they're charging you $200 plus an hour, it's often better that you do as much as you can rather than pay them to do some of the easy stuff, such as adding up entries and expenses.
And when do businesses need to lodge their returns?
So if you're lodging yourself and you're not using a tax agent, you do actually need to lodge by the 31st of October each year. And that applies on whether you have got tax to pay, or if you don't, if your income's below the tax-free threshold and you are a resident, so an Australian resident for tax purposes, you still actually need to lodge a form, and it's called a non-lodgement advice form. It's a very simple one-page form. But if your income is below 18,200 and you don't lodge, you can still be liable for penalties and final notices and complications. So if you've got a tax file number, you should either lodge a non-lodgement advice or your tax return by the 31 October. You can do that through MyGov, through the ATO app, or if you're using a tax agent, tax agents have extended lodgement periods, so they can lodge right out till April, depending on what their lodgement program is. So you can actually get longer to lodge by using a registered tax agent if you're registered as one of their clients. So 31 October without a tax agent, right through till April if you do have a tax agent.
Thanks, James. Okay, Bronwyn, were there any particular questions in there on tax, or shall we move on to insurance and hit them up at the end?
Good question, Mikala. I think the only questions we've got in the chat are around insurance, so we can hit those at the end.
Fantastic, thank you. All right, so part 2. Now we're going to be talking to Debbie about insurance. Now, I know this is a topic that brings up a lot of questions, and we did get some questions prior to the webinar starting, which we'll ask at the end. So thanks for joining us, Debbie. I'll jump onto the first question, which is, what insurance is actually required versus recommended for businesses?
You're on mute, Deb. You're mute.
So sorry. Should know that by now after thousands of meetings. I'll go back to the start. Happy to be here today, and just with relation to your first question, I think when you think about insurance, it's best to think about it in 3 pillars. The first one, of course, is the most important, and that is the one that we see as mandatory or compulsory. And when you think about what's mandatory or compulsory, it normally falls into things that are governed by a lot of legislation or the industry that your business is in or that you work in. So, for example, workers' compensation, it's a requirement by law if you employ staff and pay wages. Motor vehicle, third-party property damage, so liability, it's a requirement. So you need to have that if you have a registered vehicle. And of course, any industry or licensing requirements that come part and parcel as part of the professional industry that you're in. For example, medical field, there's a requirement to be registered in that field, but also generally to have certain types of insurance covers as a mandatory requirement. The next pillar is the essential covers. So this is where there's a little bit more requirement on your part to really think about more of a broad spectrum lens on your operations and the risks to really establish what the most common ways are that a small business can get hit. So again, it's requiring a little bit more thought on your part to think about your business structure, the industry that you're in, and really where your exposures sit. If I think about some of the most obvious ones, public liability, of course, and generally this is part and parcel of most businesses, and it's there to protect against injury or property damage to others where it's perceived that you are either at fault or the allegation is that you are at fault and still have to go through a process of defending yourself where you would need to rely on your liability insurance for that. Professional indemnity. So if you are in a profession that is a consultant type of role, of course, then you will need to have professional indemnity insurance. It's not covered under liability. It's a specific product that specifically covers people that provide advice or services that have a requirement for relying on your professional knowledge. Accountants is a good example, taxation consultants, management consultants. There's a vast array of professional services that would need to have professional indemnity insurance to protect their business operations. And of course, the assets that a business owns. So whether you have business property, contents, motor vehicles, of course, those assets that you do rely on the operation of your business. And of course, you want to make sure that you're ensuring to have some reimbursement in the event of loss. And more importantly, that it's not interrupting your business activities substantially where you've got downtime due to loss of property. Business interruption, again, some thought process here across thinking about, well, what are the risks to your business? You know, if you're operating out of a warehouse or a property and something happens to that property and you can't operate your business, what does the scenario look like to your business? And what is the likely lead time that you would need to get back up and running? So this is really hingent on those businesses that rely on a property. And manufacturing is a really good example, where if there's a fire that destroys the premises, that business needs to think about what's the likely outcome in terms of a time frame that they would be down, and think about how they ensure business interruption to make sure they've got some cover there to protect the business whilst they are not fulfilling orders, for example, due to the manufacturing process ceasing for a little while. And of course, cyber, you know, this is still an optional cover that we see a lot of business still considering, albeit we always say it's not a matter of if, but when. We do see a lot of scenarios playing out that impact clients across cyber risk, but it's a choice still. Some clients are still choosing not to take it, whereas others are certainly seeing the advantage of it. But again, thinking about your business, I think we all pretty much, given that we all rely on computers, we all rely on technology. Most importantly, we do have a fair bit of data across personal data. So if you think about your customers, what data are you holding on your own systems with respect to if there is a breach of that data, what does it mean in terms of repercussions to your business? And the third piece, of course, is more the optional, but I will stress the point that optional insofar as it could be essential depending on your type of business. So, you know, in this category, we think about things such as product liability, which is more important for companies that produce a product, manufacture a product, but even if they import products. So bear that one in mind. It's not just people that manufacture products, but it's also people that may be importing products. Management liability, which of course protects the business operations against the directors being sued. It also covers employment-related issues such as wrongful dismissal, things like that, of course, if you have staff employed. And machinery breakdown, again, very much an optional, but very dependent on how much you rely on machinery to produce what it is that you may be producing, and what impact would it have if your machinery broke down. So again, it really requires a process to think about, is this really a risk to my business? If not, done. If so, what does it actually look like in terms of a downtime, financial loss, and any other loss? Because when you think about a loss, you need to also think about the reputational loss to your business. Next slide, please.
Deb, before we move on,
yep.
I just wanted to circle back to public liability, because I hear a lot of questions about that, and we did get some questions before the session. So if you've got someone who's a consultant, like lots of consultants question whether they would actually need something like public liability. Can you just speak a little bit to that?
Yeah, sure. So when we think about public liability, again, very much a three-tier system, and you would normally, like a consultant, they're probably thinking, well, I'm very much a low risk. I don't have premises. I'm not manufacturing something. Absolutely agree with that. It is what we would categorize as low risk exposure. That doesn't mean, no, that the exposure doesn't exist. It more so means that you can think about what limit of liability you may choose in that instance. And in that instance, your consultant may choose a 5 million liability. A couple of caveats around that, though. Very much governed, though, if you have contractual obligations, you need to be aware of those in terms of any contracts. And what do your contracts say? And can you actually push back if they are asking for, well, generally that you can't push back for saying, no, I don't want to take liability, but you may have some flexibility around saying, look, this is what I'm doing. I really don't need 20 million. Can we negotiate to reduce the limit of liability being requested? So we have seen that play out with some of our clients. So please bear in mind the contractual obligations, but certainly with a consultant, it's going to be governed by contracts, but also low risk, So you may opt to have, say, a 5 million liability cover, which is very standard. Bear in mind as well that you're still visiting customers, clients. Clients may be coming to visit you. So there's still a level of low risk exposure that exists with your business activity still being undertaken, albeit they are lower than someone that, say, is manufacturing or has a shop where there's a lot of traffic in terms of individuals coming in and out on a daily basis.
Fantastic. Thank you for clarifying that. Okay, so the next question, what are the risks of being underinsured?
This one is a bit like how long is a piece of string for me. So there's a lot of risks that exist with being underinsured. And I think when you think about it, underinsurance isn't just a payout issue, which of course it is, because if you are underinsured, the insurer will obviously look at a payout which is well below what you should be insured for. But most of the times they'll also kick in what we call the co-insurance clause. So or underinsurance clause. So if you are underinsured, particularly in a commercial asset property perspective, the insurer can have the right to trigger that clause, which means that if you are insured for 100,000, but you should have been insured for 500,000, you won't just automatically get the 100 that you've insured for. The underinsurance clause will kick in, and the insurer will use a formula to determine how much they'll pay you. So please bear that in mind. Just because you're paying a premium for 100,000, if you are substantially underinsured, the insurer doesn't have to pay you that full amount that you've insured for if you are underinsured. So some other things, some real world examples that I can absolutely provide that we have seen time and time again, unfortunately. Fire and water damage, of course, is a big one, which most people would be aware of. Insuring contents or your property for that matter, very much underinsured. If you think about insuring assets for your business, it does need to be based on replacement cost. So what would it cost to replace that item? So your building's destroyed or partially damaged. What would it cost to actually rebuild it? Or your contents, what would it cost to go and replace those items? So if you are underinsured, that shortfall, of course, is a financial loss for you. But it's also what delays will it what delays it will have in terms of you being able to reopen or get back to your normal level of business activities due to this loss impacting your business and your business operations. Liability claims are really contentious because of the fact that they can go on for a long time. And whilst you may think that you're not liable, unfortunately, lawyers tend to sue everyone and anyone that may have had an involvement in whatever the process may be that's resulted in a liability claim. And then it's up to you to fight it out, or your lawyer, or your insurer, or all, to show that either you weren't liable or you're only partially liable. So in that instance, claims can go on for a significant amount of time, particularly liability claims. And whilst that's happening, legal costs are mounting. And of course, it's the toll that it takes on not just your business, but also the emotional toll that we've seen time and time again that it can take on individuals as well. So a small limit can in fact get chewed up very quickly when you have claims that go on for 2, 3, 4, 5 years, and legal is involved throughout that process as well. Ransomware invoice fraud. So this is something that would be covered under cyber liability insurance. Businesses can't access systems. Think about what would you do if something just popped up on your system that said, we're holding you to ransom, or we've got your data and you need to pay us this. What have you got steps to protect yourself? What would you do? Do you have insurance for that? And if not, it's not just the recovery costs. It could in fact destroy your business entirely. Insurance can kick in for this, and we have seen it kick in for these types of scenarios. And I think the most important thing that I can call out here is it's not just the proactive approach of dealing with it, it's also the reputational damage that can come with not dealing with these matters quickly. So please bear that in mind because it is a big one when it comes to things like cyber liability, breach of data type claims. And just equipment theft. So tools stolen from a vehicle or a site, is that going to impact jobs that you've got lined up? How quickly can you source that equipment to replace? So all good questions to ask yourself, particularly if you're in construction business, and making sure that that downtime is minimal. So it's not impacting your business operations, not impacting jobs that you can finish. And then, of course, that domino effect again is that reputational damage if that does happen. So impacts to call out, financial obviously is a big one, out of pocket. Cash flow is distressed because of unexpected bills that you've got to pay or replace things. And of course it does, and we have seen it leads to businesses folding because they just can't recover from such a loss that they've incurred. Operational, so again, downtime. You may lose contracts because you can't fulfill those contracts. And of course, the reputational damage that comes with that. And of course, personal. We don't want to lose sight of the personal impact. Dipping into your own personal savings, taking out more loans to cover debts. And of course, it's the emotional toll that it takes on individuals as well.
So Debbie, I personally find insurance quite overwhelming and a bit confusing. How can businesses avoid overpaying or duplicating cover?
Good question. So when we see overpaying happening, it's there are some common traps that we tend to see as brokers. And what they come down to is that there's policies that are in fact overlapping. And by that, I mean, if we think about cyber insurance, you can take out a cyber insurance policy, which is what you should do if you want to cover that risk. However, what we see is that there's some business pack insurance policies where insurers will have cyber in there as well. Whilst it's some cover, it isn't as broad as what a cyber insurance policy would be. However, if a client's got cyber insurance, they don't need to have that cover that's sitting under the business pack unnecessarily. So you don't want that overlapping because one, it could be that you're paying more in terms of insurance premiums. Two, you don't want arguments across which insurers are going to pick up the claim. So it's just better to not have any overlapping of cover because at the end of the day, you're going to be paying for it if you've got those types of covers in place that the insurers put on the table. The default add-ons is very similar to overlapping policies, except it's more about you have packaged insurance products that, again, what we call bells and whistles. So the bells and whistles is, insurers throwing in all these different additional coverages under your insurance policy that may in fact be, again, just add-ons that are sitting under 2 or 3 different insurance policies. And we tend to see that across certain types of policies. It can be things such as travel insurance. If you're thinking about travel insurance and then you've got travel insurance under a corporate credit card type scenario, the add-ons may include things such as hire car, but then you're going and hiring a car and you're taking out the insurance cover on that. So think about the structure of your policies even to that level. Travel insurance covers hire car. Do you need it if you're taking that option through the hire car company when you're hiring a vehicle? Outdated sums insured is probably the biggest one. Unfortunately, we do see situations where annual reviews are not happening with clients. And what that means is that a lot of your sums insured are just outdated, either too low or too high sometimes because the business has changed, but your risk has changed, but your level of cover has not changed to reflect the changes that are occurring in your business, whether you're buying more assets, The cost of living, of course, in terms of inflationary pressures going up. This impacts on what it costs in terms of a claim. So all these things do add up, which is important as to why you should be reviewing your cover annually. And also providing updated information if you do use a broker. Things such as how many staff you employ, what the turnover of your business is, and also double checking any lease requirements, because they are just as important to ensure that you're abiding by any lease requirements that you have. Multiple decision makers, this may not impact some of you here, but if you are in a company structure, it's easier to have one person appointed that is the insurance person. Having multiple people within one organisation, so you may have the finance person that has a vested interest, you might have the IT person that's got their own vested interest. It does complicate things, and what you find is that sometimes you may also get some overlapping of covers, because there's this silo effect occurring within the organisation of them not collaborating and working together. So they can be involved, but stripping out them being the key decision maker is important, and having one central point. And last but not least, the low value extension. So sometimes we see, clients having some extensions of cover within policies, but they're not needed. Some of them we've seen where they don't even have a risk exposure with some of the extensions that may exist in a policy. So it's like, well, why bother having it if you're never going to have to claim on it? Just strip it out. Because again, at the end of the day, it's all about cost as well when it comes to thinking about your optimization of your insurance program. So some of the practice, sorry, I should just also say, please avoid set and forget. It's really easy to say, oh, it's insurance, I'll just renew it. Really think about the business activities, what's happened in the 12 months, what's happening in the next 12 months that may also impact how your insurance should be set up to best protect your business. So just a couple of things. So I might just pause there in terms of the quick checklist. Sorry, might just touch on this. So there are a couple of things that, or some practical ways that you can probably prevent duplication and reducing that cost factor. So again, as I said, doing an annual coverage check. So have a look at your policies. Is it covering the right exposure? Just having a look at those add-ons. Are they necessary? What would happen if you strip them out? Ask the questions, because you've really got nothing to lose. Look at your key assets and inventory and think about how they're insured, and look at revaluing those assets as well. If you've disposed assets, are they still sitting in your insurance? Have you purchased assets? Have you got those insured? You'd be surprised at how many times we get clients saying, oh, I forgot to tell you we bought this car 3, 4, 5 months ago. So it does happen. And manage your renewals centrally. As I said, it's really important to align the person within an organisation, but just as important is thinking about who actually assists you with your insurance. And by that I mean, do you have an insurance broker? And if you do, is it 1 or 2 or 3? We have seen clients that have 2 or 3 because they don't want to put all their eggs in one basket. The problem with that is that you don't give a broker an opportunity to optimize your program, limit overlaps, review your covers, align the renewal dates, and maximize that value for money for you.
And that's a beautiful segue to our next question. What is the role of an insurance broker?
Good question. So I think when you think about an insurance broker, it's really about thinking about what it is that you need. And an insurance broker mostly gives value to individuals or businesses across certain scenarios. So if you're thinking about scaling your business, hiring staff, signing contracts that have insurance clauses, insurance brokers actually review those insurance clauses within contracts. So there's one benefit of having an insurance broker involved. because we can make sure that we're looking at those clauses and making sure that your business operations reflect the insurance cover that's required within those contracts. If you've got multiple locations, multiple vehicles, if you use contractors or subcontractors, again, the complexity of that, it's really difficult to just go out and do your own insurance cover. A broker, however, can collate all that information and make sure that they're approaching the market. So they'll approach various insurers and look at or scope out insurance cover, not just on cost, but also optimizing the program so it's best fit for your business. So if you need professional indemnity, cyber, management liability, they are typically more technical insurance policies, and absolutely we would encourage people to be going through an insurance broker for those tailored type insurance products. If you're wanting to compare policy wordings or limits or exclusions, again, that should be part of your broker's role to ensure that it is in fact maximising the coverage you've got. And of course, claim support, the most obvious one. So your broker should be there advocating from the start of a claim right through to the end. And we've seen many claims that have not gone well. For various reasons, insurers have declined claims. However, we've been able to pick apart the policy wording and gone back and argued and defended and advocated for our clients, in which case they have provided a settlement. So it's a really important one because that, of course, is the big value add with respect to clients and wanting to see the outcome of purchasing an insurance policy and knowing that they've got the cover there. So thinking about tailoring cover. So a broker, of course, needs to understand your business, and that should be an ongoing basis. It's not just learn once and then forget about it. It should be sitting down once a year as a minimum to run through your business operations, what's changed, what's the same, getting all that updated information, because that is the only way that they can go away and tailor cover that is there to optimise the coverage, but also value for money in terms of the insurance premiums. And of course, as I said, just that claim support and advocacy, it is a big one because we are unfortunately seeing, you know, a lot of new insurers coming into the market. And when things start going a bit tough in terms of more claims coming out of the pipeline, we are starting to see more declines of claims. And we are starting to see a lot of our time going towards advocating for our clients in that space.
Awesome. Thanks, Debbie. And one more question. What's one thing that every business should review this year?
So I think it's important really just to take stock of what insurance you got in place, but thinking about what's changed in your business, you know, the people, the revenue, the location or locations, the services that you provide. Have you expanded the services that you provide? Have you signed any new contracts that have particular insurance clauses in there? And of course, have you updated any of your assets or disposed of any assets? And your systems. Have you updated any of your systems? Because that's a critical one as well when you're thinking about the overall business operations and thinking about what insurance might look like based on those factors. So a couple of things I would suggest is probably check 3 numbers. So look at your contents, your stock, or just your building, your equipment. What replacement value have you got sitting across those? Have they been the same for the last 2, 3, 4 years? If you are increasing them, how much are you increasing them by? So just a couple of questions like that to think about the structure of those sums insured. If you do have business interruption, think about the period of interruption cover that you got. So generally, clients can take, on average, it's about 12 months we see, but certainly if you own a building, we would absolutely be advocating to have more than 12 months cover. What the period means is how long do you think it's going to take for your business activities to recover if there is a substantial loss that impacts your business. And if you have a building that you're relying on, I can guarantee you 12 months is not going to be enough, particularly if you have to go through council approvals and line everything up in terms of architects, builders. It can go on 24, even longer, 24 months plus. So really have a think about that period. And your liability limit. So again, as I said, really make sure that it matches your contractual requirements first and foremost. But is it realistic to cover worst case scenario in terms of thinking about your business activities and ensuring that it is optimal to protect you? And last but not least, most brokers these days do provide a complimentary insurance health check. So what that means is it's really about looking at your current insurance schedules. Sometimes clients will also provide policy wordings. If so, great, because it allows us to really dig deep and just pick it apart. It is literally just picking apart your insurance to have a look at how it's structured. Is it optimal? Are there any gaps in coverage based on your business? And then providing a report to you to demonstrate, look, this is great, this isn't so good, this is our recommendation. So it's just a fact-finding exercise to determine how fit for purpose your cover actually is to cover your business.
Fantastic. Thanks so much, Debbie, for all of that. That was really, really interesting. I learned a lot. I have my own business and there's a lot I thought I knew, but I didn't. So I appreciate your time, both you and James. Now, just before I hand back over to Bronwyn, who's going to manage the questions, there was one question that we were asked before the session, which was about workers' compensation risks and an ageing workforce. I just want to mention that that's actually going to be covered in detail in the upcoming Managing Emerging Workers' Compensation Risks workshop. So if you want to learn about that, please register for that workshop and I'll be answering those questions there. So I'm going to stop sharing and hand over to you. Thanks, Bronwyn.
Thank you, Mikala, and thank you, Debbie and James, for your very insightful presentations. I'm sure all of us have learned a lot from that. And I just want to officially wrap up the meeting and say thank you, everyone, for joining. The recording will be online soon and we'll open up to questions in a moment. But yeah, thank you, everyone, for coming along and we'll see you at the next one.